You know what people love more than cute puppies? Not paying taxes. And that's why people love tax-deferred accounts like the Roth 401k and the Roth IRA. Now, there are requirements or limits on certain accounts when it comes to either the Roth IRA on the income side or when it comes to the total amount of contribution on the Roth 401k side. But there's actually little loopholes that you can use to contribute more to these accounts than you're supposed to be able to. So if you want to know about these little loopholes, stay tuned. You have all these different accounts, whether it's traditional or Roth, but Roth is the account where you contribute after-tax dollars, and then when you withdraw, you don't pay any taxes on the gains of those investments. So if you contributed $100,000 into your Roth 401k and Roth IRA, and that turned into $400,000, well, in retirement, you wouldn't have to pay anything on that $300,000 worth of gains. So pretty sweet. Now, when it comes to the limits, the Roth IRA on a yearly basis is $6,000, but you have to be making less than a certain amount, so $124,000, and then it gets phased out, so you can only contribute to a certain amount, and it's lowered as you make more money. For the Roth 401k, there is no income rules, but your company that's employing you would essentially have to have this option. Not all companies have the Roth 401k option. When it comes to maximum tax-deferred contributions across all accounts, whether that's an IRA or a 401k through your employer, the limit is $58,000. So realistically, you have $6,000 here, $19,500 here, and you have $38,500 remaining that not a lot of people talk about that you can actually use to roll into a Roth IRA. Obviously, this video is targeted more towards higher earners or people that are very aggressive when it comes to trying to reach that financial independence number. So maybe they have a higher savings rate and they're trying to achieve retirement earlier. Something else that's important to remember is that the total contribution is between you and the employer. So if the employer contributes $50,000 to your tax-deferred accounts, well, you can only contribute another $8,000. Also, the other rule is that you can't exceed your income. So if someone is making $15,000, they can't be putting more than $15,000 into these tax-deferred accounts. Now, if you're in the situation where you can't be contributing more than these limits, you can still save this video to watch later or just know about this in general. So when you increase your income and you're in the situation where you do want to save more aggressively, you can take advantage of these loopholes. Or maybe you're in the same situation I was with my last employer where they have an after-tax contribution, but they don't have the Roth 401k. So you still want the benefits of a tax-deferred account, but you want to be able to get your after-tax contributions into something like a Roth IRA. Also, let's say you're not the person contributing $38,000 extra to your retirement account, but let's say something like an extra $5,000. Well, over 30 years compounded annually at an 8% rate, you're talking about $566,000 of tax deferred in your account versus $371,000. So it's almost a $200,000 difference in tax savings if you rolled it into a Roth IRA versus just keeping it in that after-tax account or a normal brokerage account. So here's the big kicker. You need to have a 401k plan that allows after-tax contributions. Otherwise, this video doesn't really work. So that would be the first thing that you check, because if you don't have that, well, then you're stuck to the limits that are basically stated by the IRS. As only around 25 to 35% of plans even have this third type of contribution, which is after-tax. And then your question is, if they do have this, what's the difference between the Roth and the after-tax? Well, they're both after-tax contributions, but with a Roth, you don't pay any taxes on the gains of those investments while it's in the account. Whereas after-tax, you essentially are just depositing money into a brokerage account like anything else, and when you withdraw that contribution, you pay taxes on the gains. Okay, so why are we even talking about an after-tax contribution? Well, here's the interesting thing. So with an after-tax contribution, even if your employer doesn't have a Roth option or you make too much money, you could possibly turn that after-tax contribution into a Roth IRA and get all the benefits of tax-deferred wealth generation, and you wouldn't be taxed on the gains. But there are some caveats and some things that are important to know. The easiest one to understand is an in-plan Roth conversion. So if you have an after-tax contribution, you can click a button and turn it into a Roth 401k. Now, the tricky part is you have to do this before it's actually invested, because if you contribute $2,000 and it gains to $2,200 based on investments, Well, when you convert it, that $200 will be taxed, whereas the $2,000, the contribution itself, will be converted into the Roth and it's not a taxable event. So it's important to remember that when you actually contribute to your after tax, you have to go in right away and convert it. When there isn't an in-plan Roth conversion, it gets a little bit more complicated, but this is actually what I did. So you have the after-tax contributions, and then what you do is you roll it over into a Roth IRA. Now here's the caveat. One, some plans don't allow you to do this while you're still at the company, so you can only do it when you leave. And then two, when you contribute money to the after-tax contributions, only the contributions themselves can be converted to a Roth IRA. So let's say you contribute $10,000 to your after-tax contributions, and it grows to $14,000 if you invested it, right? And a couple of years later, you want to convert it to a Roth IRA. Well, the $4,000 in gains can actually be taxed when you convert it. So what they can do is they can take that $4,000 and actually put it into a traditional IRA. So you kind of kick the taxes down the road. But then you can only convert $10,000 of the $14,000 into a Roth IRA. So at that point, if the investments grow, then it's tax-free. It's a little complicated, but essentially you want to be able to roll over your after-tax contributions as soon as you get them. And guess who made that exact mistake? This guy. I called Fidelity and was telling them, hey, I want to convert my after-tax into a Roth. They were completely understanding, and then I was a little confused why the amount that was being converted to a Roth wasn't the exact same that I had in the after-tax contributions. That's when they told me that you can only take the contribution part and put it into a Roth IRA, and then I could take all of the gains that I had in the after-tax contribution account and turn it into a traditional IRA. So just something to watch out for and learn from my mistakes. If you're wondering, well, can I take just the after-tax contributions and roll it into a Roth IRA while leaving all of the gains in that account to avoid any taxable event? Well, no. The IRS says you can't do that, but you can essentially do what I was talking about, where you take the gains and put that into a traditional IRA to avoid any taxes on it, and then the contributions themselves into the after-tax account can be turned into a Roth IRA. And for those of you that have watched this video and are self-employed and wondering, well, how does this affect me if I don't have an employer? Well, you can set up your own Roth 401k with your business, and you can essentially do the same exact thing. Now, something else to consider is if you have a Roth 401k and you don't love the options within the fund, right? You can only invest in certain investments, and you want the flexibility to invest however you want. You can roll that into an IRA. So if you have the Roth 401k, you can always roll that into a Roth IRA, which would allow you to be more flexible with your investment options. Now, this doesn't increase the limits that you have with tax-deferred accounts. It's just something to know about. Now, each person's individual case is different, so by no means is this tax advice or financial advice. You should always consult the 401k plan or your financial advisor before actually doing anything. But when it comes to the information, now this actually exists, and kind of some of the high overview looks of how you can actually increase the limits that you're contributing to these tax-deferred accounts. If you did enjoy the video, make sure to hit that like button and subscribe to Main Street Wolf, where we talk investing, personal finance, anything to do with money. Thanks guys for watching, and have a great day.